Hi, it is Dan Kurz of DK Analytics. It is June 16, 2017, 2 days after the monumentous, quote-unquote, decision by the Federal Reserve, its FOMC, the Federal Open Market Committee, decided to raise the short-term interest rates, which the U.S. Central Bank controls directly the Fed funds rate to from 0.75 to 1% to between 1% and 1.25%. That's the fourth increase in that rate since they initiated their interest tightening cycle. And we're going to discuss that and some related things. But first, a brief detour, if you'll allow us, some housekeeping things regarding the site. Our DK Analytics site, which we have made available to subscribers on a free basis, publications, both posts and reports free of charge. We need to, at this point, given lacking traction in the local Southwest Florida asset gathering venture, shift to an attempt to monetize those new publications that will have considerable depth and breadth and links and sources. And as such, we're going to be looking to net $10 per new publication, written publication, while accompanying that effort with the audios or the videos along these lines. And in so doing, we hope to wet your whistle or get your appetite aroused concerning delving into more depth in a written format and paying a hopefully Main Street fee for those, as said, roughly $10 per full report. We will continue to throw some mini posts or smaller publications in there free of charge, but we need to find a way to pay bills, quite frankly, at this point, because, as said, we failed after a multi-year effort to monetize a joint venture effort in Southwest Florida as concerns adequate asset gatherings and maintaining a joint venture partner status, which unfortunately has ended at this point in time. Back to the issue at hand. 2 days ago, June 14th, Janet Yellen came out in the FOMC meeting and announced this another ratcheting up in the Fed funds rate, promised 3-4 more, quarter at a time. And they also knocked a lot of people's socks off, mine included, as regards moving from quantitative easing, or that is expanding their balance sheets with more bonds, agency bonds, and even stocks, as at least a lot of central banks are doing, or some rather, that they're going to move to do open market operations, do quantitative tightening, or reduce their balance sheet, and thus increase the supply of bonds and agency bonds like Freddie and Fannie onto the marketplace. That's a big deal, especially given where we're at, and that is an economic situation in the United States, and by extension most of the world, that is not growing as it should in order to sustain tightening monetary policy. The Fed has said in the past it's data dependent, but it's going forward here in a manner that suggests it's doing it despite the data coming in that is pointing to a protractedly weak economy getting weaker, right? Which is, again, largely a child of Fed policy and what we've often termed a toxic public policy stew. We'll get into that just a little bit. That is killing the goose that lays the golden eggs. That is killing the invisible hand of Adam Smith and free market capitalism, as the spoils are being carted off to from makers to takers, from creditors to debtors, from free market participants to crony capitalists. So this is all part and parcel of this whole system that doesn't want to die, and a lot of people are in entrenched, powerful positions, want to sustain it. So we can't really revisit economic health and wealth and sound productivity and allocations until this is done away with. In the interim, however, We have an economy in the U.S. that is close to, in my opinion, collapse, that is not going to be able to withstand tighter monetary policy unless we remove the toxic public policy stew, which won't happen, as we've reported many times, until it absolutely has to. Just how is the economy weak? I mean, let's just take some telltale signs and then juxtapose it against the Fed's relatively tough monetary policy. Unprecedented government, corporate, and personal debt. This is borrowing from the future, suggesting less demand weakness, less purchasing power going forward. And let's not forget the consumer is 70% of GDP. We've got faltering loan demand, also commercial loan demand. We've got weakening retail sales in the U.S., actually inflation adjusted down. We have a huge consolidation of the overstored nation. The America's retail square foot acreage, if you will, is beyond that of any other country by far when it's whittled down to a per capita basis, or let me more correctly say, not acreage, but just the square feet per consumer in America is something like 3-4-fold of the global average. So we've not only got weak retail sales thanks to weak full-time jobs, to low labor force participation rates, but because America's dramatically overstored, and this retrenchment speaks volumes about, frankly, the state of consumption and, by extension, GDP growth as a whole. We continue to have, as mentioned, weakness in full-time job creation. All these jobs are being created in the U.S. or you lose one high-paying full-time job and you replace it with 2-3 part-time jobs at much lower wages per hour and none of the social benefits, and that's certainly not being represented in a historically low unemployment rate, to put it nicely. We've got weakness in auto sales. We've got continued bloating of inventory channels. The dealerships are just, that's how car sales are reported by the car manufacturers when they sell them to dealers, not to consumers. And we have record high auto loans, which are obviously another one of the bubbles created by our current toxic public policy stew. We have, lo and behold, 113 months of stagnant manufacturing in the United States in real terms. This is the longest stretch in history of the country. Again, it doesn't exactly speak volumes about the strengthening economy, much less economy that can sustain the growth trajectory that it had, which has been extraordinarily weak, the weakest ever post-World War II recovery. We've got a shift, at the tax receipt level. That's another way to look at this. We've got a shift from nominal growth in tax receipts of governments at virtually all levels in America to nominal decline. And obviously this all is reflected, however belatedly, in a weakening real GDP growth rate. Now, how long until the Fed, which is going in the direction of a tougher monetary policy, be it the Fed funds rate and its threats, quote unquote, to eventually hit the run rate of $600 billion annually of agency bond sales, throw them into the market? How long can the emperor go in a direction of tough love, monetarily speaking, while the economic emperor wears no clothes and the political consensus isn't there to go through a revisiting of Schumpeterian economics, of tough love, of letting the weak fail, of restructuring, and frankly, of getting to a healthier place where the invisible hand of Adam Smith and price discovery once again makes an economy flourish and raises the fortunes of the most people possible. That was what it was supposed to be all about, and we've lost it. And with a current political situation in the United States, where we're close to, in essence, a civil war in many ways, at least in terms of the violent left and the people on the constitutional side. We're not in a position, nor do we have politicians in Washington that are ready to shrink transfer payments and redistributionism, and as such, the Fed will be forced, in my opinion, together with its huge focus on the wealth effect, right? I mean, it went out there and increased its balance sheet by what? Pushing down the yields, pushing up the prices of treasuries, pushing down their yields, forcing people into stocks because there aren't any yields on bonds and so-called secure investments. So you have yield starvation, forcing people to punt and riskier assets. And this wealth effect they're so focused on is supposed to engender more consumer spending and all this other Keynesian rubbish, which never ends up working. But they can't step away from that plate. So again, I come back full square and I say, or full circle, how is the Fed going to carry forward a tough love monetary policy given an economy that's heading south and no political consensus to return to fiscal economic sanity? I also wonder, and I very much include the Obamacare debacle in this toxic public policy stew, which is huge redistributionism from makers to takers. But I often wonder how the news of, in essence, a non-recovery in the U.S. will impact the value of the dollar, and by extension, physical gold and silver, silver being, kryptonite for the U.S. dollar. And in a related manner, as regards this initiative by the Central Bank of the United States, the Fed, to keep bumping up short-term interest rates, the Fed funds rate, on the one hand, and then actually move to, over about a year's time, to up to $50 billion a month or $600 billion a year in shrinkage of its balance sheet, stuffing the channel, if you will, the supply channel of treasuries by up to $600 billion a year. How this will actually serve to depress interest rates when all these central bank interventions to take out price discovery, to trump, if you will, the free market's determination of interest rates, to move, in other words, the demand curve for bonds and by extension stocks, because again, if the bond yields are too low, you're going to force people into stocks, yield deprivation. But if you in essence set the floor of these assets much higher so that you have lower yields and higher P's, you engender an environment which you figure the wealth effect is going to result in the spending that otherwise wouldn't happen. That is, if you can't move the money supply because the multiplier is shrinking, or you can't get traction on velocity through these machinations, the artificial monetary, fiat monetary policy, then at least you're going to get it through the wealth effect. Well, that has proved to be a dismal failure, which is why Trump was elected, why the whole globe isn't growing. But we do have those asset bubbles, and those are the fruits of this harvest. Those are the children of central bank zero and negative interest rate and QE and asset levitation policy. So for some people to now come and say that if the Fed starts to shrink its balance sheet, that this is going to reduce the yield on bonds or further increase the value, I think is truly ignoring the laws of supply and demand. Concretely, you're going to have less demand for these bonds because of less central bank intervention. And on the other hand, you're going to have a lot more supply hitting the market, which to me suggests very clearly a higher clearing price for long bonds. And let me go through that piece by piece and run it by you and see what you think. But you should dial it into future asset allocations, investable asset allocations, because the clearing price of all assets is ultimately determined by, in terms of long-term assets, not 1 to 5 years, but 5 years and above, is determined by the yield on a 10-year Treasury. That's the discount rate upon which you load on and some risks for solvency and risks for inflation to then ferret out to arrive at a net present value of stocks and other instruments and corporate bonds and the like, depending upon what the current or the future interest rate on 10-year Treasuries is and other investment grade 10-year government bonds. So this isn't an academic matter. Now, let's take a look at what would happen if we in fact had a Fed that went through with this, which to state or to restate, I don't believe for a second that this is going to be doable, given our economy heading south, the lack of political will to change things for the better, to take the pain of such a readjustment. It ain't going to happen until it absolutely has to happen, right? But let's say the rest of the world, which has a huge holding of U.S. Treasuries, there's sources that claim up to $16 trillion of overseas American dollars swirling around. Treasury holdings overseas is also very large, in the trillions of dollars. What happens if the rest of the world, because, for example, the oil price is lower, oil is still priced in dollars, let's say you need less dollars than you did before. Let's also say that they're more bilateral, non-US dollar based trade deals. Last but not least, let's say that because the dollar, if it weakens, requires less foreign currency to purchase, that there's also less need for foreign countries to acquire dollars. All these things, in my mind, or at least combined, are dollar negative and not supportive, meaning if you don't need as many dollars, you end up tending to sell treasuries, the most frequently held US dollar asset by the rest of the world. On top of that, the funding needs of the US government in a recession can easily double. If we look at real deficits today, they are on the magnitude of $1 trillion a year. Not these phony statistics that the executive branch has thrown out, but rather take a look at another part of the executive branch, actually the Treasury, and instead of looking at the deficit to the U.S. government in any one year, I think last year was around $600 billion. If you look at the increase in debt of the U.S. government, as published by the Treasury, it's in a lot of my posts, 17, 18, and 19, you find sources of this, or at least on one or two of them, you will see that year after year, on average, U.S. federal debt has been going up slightly in excess of $1 trillion a year. That's the true deficit, not the manipulated one. If we run into recession, where tax payments are down because jobs are down, incomes are down, and transfer payments go up, and people get a lot of assistance given higher unemployment levels, we in essence, really arc up on redistribution, and we could easily have a deficit that's 500 billion to 1 trillion larger than today, just from moving from a weak economy or a weak recession, which we're currently in, into a stronger recession. And this isn't too hard to fathom, given history, given developments. We can look at 08 and 09 for details on this. Furthermore, none of this, well, my current remark does not include tax cuts, corporate tax cuts, which will take a while to kick in, but will, gnaw at about 15-20% of the government's overall revenue. Most of it is from private citizens, and it doesn't address heightened infrastructure spending or Keynesianism, which politicians love to do whenever the economy's weak, right? Cut taxes, increase spending, and if this too is layered in or added in, we could very easily see a 1 trillion plus increase in the annual funding requirements of the U.S. Treasury. Now, let's say about 200 billion in reduction of holdings by overseas accounts, and this has happened. We have a short history of this, but if the rest of the world needs less dollars for the reasons mentioned, either more trade in the non-dollar realm, cheaper oil, they don't need as many dollars, or they're convinced that the dollar is heading south, not north, as it has been this year, then all these things will require less dollar holdings, less treasuries. We could easily have 200 billion per annum of sales from the rest of the world. We could easily have an additional 1 trillion or 1,000 billion in funding requirements by the U.S. government. So they're going to do what? They're going to put treasuries out there to soak this up, to soak the funds up with, especially if we don't have the Fed printing the money. And sticking to that point, if the Fed now in addition throws, once it gets up to its full run rate, $600 billion worth of treasuries and perhaps some agency bonds, Freddie and Fannie, onto the market, then we are very quickly looking at an annual additional supply of mostly treasuries of in a neighborhood of 1.5 and $2 trillion. All right, that's how much increased de facto supply we're going to have in a market. I think we're going to need a higher clearing price to get the demand to soak that up, and that is expressed, ladies and gentlemen, in a higher interest rate, which the U.S. economy can ill afford, the government most especially. It is indebted at a rate where almost $20 trillion is being financed at an average rate of 1.2%. That 1.2% being reflective of short-term maturities. They have been borrowing long-term, as we know, and if the Fed continues to hike the short-term interest rate, the Fed funds rate, we could, over a short period of time, easily have a 100 to 200 billion, let's say a hike at on average 1%, and the U.S. government needs to refinance itself given the short-term duration of its funding portfolio, then to layer on top of roughly $2 trillion that I've just explained or detailed in additional supply coming out of the market, U.S. Treasury funding requirements, the government might well need 100 to 200 billion more in funding because its cost of funding has gone up as a result of Fed policy. I don't think this is going to happen, but this is how ridiculous this is, pardon my French, in today's world, but it is what we have to look at as investors to value assets and also future valuations of assets. Interestingly, if one takes a look at the global valuation, these bubble valuations in bonds, especially in bonds, but also in stocks, meaning there's no way that investors are going to get decent return given the elevated amount they're paying for the earnings power and also the limited risk compensation they have for both solvency risks and monetary inflation risks. This holds true for bonds and stocks, right? Both assets in this camp are giving investors a very pathetic rate of return going forward, and in fact a real loss of capital potential layered on top. So this isn't academic, but think of it this way. Would you go out, let's stick with bonds for a moment, would you, when people talk about government bonds being a good bargain and the Fed moving to go to quantitative tightening again, which I don't think is going to be possible for the reasons mentioned, but let's, for the sake of argument, say it does happen. Let's take a look at a Fed that moves to reducing its balance sheet, right? In a time when we have very low interest rates. I'm going to argue negative real interest rates if we had a real world inflation number. That suggests to people that over time, as the federal government cannot sustain its commitments, cannot make its commitments with an aging population, be it Social Security, be it health care, be it veterans benefits, it is underfunded massively on all those schemes, up to 200 trillion, according to one economist from the University of Boston. There's no way the government is going to be midterm, long-term, able to make good on all the commitments it has, not to mention turning over and funding or paying down $20 trillion of operations debt, which means one thing. The only politically tenable thing is to inflate out of this, to print the money so that people get what they've been promised, but it will be in effect, well, it'll be taking it away via inflation instead of a default, right? So if one looks at government bonds today as ownership in such a Ponzi scheme, a global Ponzi scheme, and one compares it with corporate junk bonds, who would buy a junk bond, which is what all government bonds are, with very few exceptions around the world, that offered a negative real yield, i.e. no real yield, no inflation protection, and crappy solvency risks? Doesn't make any sense. In that sense, not only do we believe that the Fed's interest rate increase policy and its QT policy will be short-lived if it'll get out the gate at all, but it is to be considered in light of the continued massive bubbles, the bubble valuations we have in bonds and in stocks, and how investors that are currently so invested and might have significant gains can keep their wealth and then be positioned for the inevitable reset of asset values, bonds, stocks, and real estate, and most other assets that will go from boom to bust. In other words, a lot of analysts talk about reversion to the mean. There's no reversion to the mean. That's ridiculous. There's a reversion beyond the mean. You don't go to an average PE. You don't go to an average 4% bond yield in the US of 4% or Great Britain. You don't go to an average PE of 16, 17 times. No, you go from 26 times to 6 times, right? So and if you layer on top of that a lot less earnings power of companies, right? We talk about a stock market which is levitated and the Fed and other central banks standing behind it. Well, what happens if those earnings go down by 30 to 50%, which they typically do in a run-of-the-mill recession, not an over-indebted one, misallocated one like we're steering into, with lower productivity also on board, and not securing dense energy sources also on board, all part of our public policy stew as engineered, as enabled, as sustained by the global printing press. So, buyer beware, caveat emptor. Take this opportunity. I know we sound like a broken record here, but it's true. Take this opportunity, not the broken record part, but the fact that you cannot change what markets are telling you and what valuations are telling you. Namely, get out of harm's way, sell bubble valuations, assets that promise nothing but a negative return over time in bonds and stocks, and push them or reallocate them into secure cash. Avoid bail-in risks. In the US, buy Treasury bills. You don't have an inflation problem. The duration is too short. You can also consider parking some of your money in an outfit called goldmoney.com. That is a Shift Gold, Europe Pacific vehicle, a joint collaboration, I think, across the Atlantic with a gentleman in London. For the sake of declaration, I have an extremely small $200, $300 position in that, take it out of a Wells Fargo account. Why do I mention that? Because if you're talking about going cash, getting out of harm's way, waiting for sensible asset values, waiting for a reset from boom to bust, where you can get PEs of 6 or earnings yields of 12 or 13, where government bonds are yielding 8 instead of 2%, something like that, it'll be that big, then if in the interim you go into short duration treasuries that can't be bailed in, they can print the money to pay you, or you consider actually taking your current account balances and reducing the bail-in risks, reducing inflation risks by moving them into an account wherein you are purchasing ounce for ounce at the given price gold, right? And a very solid outfit like Brinks that has never lost anybody's property in 100+ years stands behind this. So you have a way of having cash, being exposed to gold, and in essence revisiting what the monetary system used to be, namely backed by gold and not fractionalized and fiat, but actual representation in underlying gold in a secure place with secure and well-established entities watching after it. Now, and the majority of the money you take out of overvalued stocks and bonds that you don't need in a current account, that you don't want to tie into gold and at some point silver, you will want to have in physical gold and silver and in scarce real assets. I keep saying energy complex, dense energy assets, fossil fuel assets, and ag assets, because both energy and food always historically get very expensive, difficult to source in times where currencies destroy themselves, print themselves into oblivion. That is what is ahead, and that is why we hold the stance that we do. Enough said. Thanks a lot for listening, and we hope you tune in. We're going to be back in relatively short order for our initial video on cryptos versus cryptocurrencies versus gold and silver, and also the globalists' apparent win in Europe, where the elections in the Netherlands, France, and sadly now Britain suggest that the Borg is assimilating pockets of resistance, that is, people that want to sustain national solvency and sovereignty are being overruled. And at the end of the day, sadly, people get the governments that they vote for. But my generation has also equally sadly been indoctrinating our youth for all too long to believe in cotton candy instead of free market capitalist tough love. Bye-bye.